Hello everyone, welcome to another video. Today we are going to discuss about inventory period and physical count. As we know, if you want to report the inventory in financial statement, it should always be based on physical count, okay? Because inventory which is showing in the record, it might be different than physical inventory. So here you need to understand a perpetual system also and a periodic system as well, because these two inventory management systems we have already discussed in the previous video. But just a quick overview: under the perpetual inventory system, what we do, we update our inventory records on continuous basis, like I mean to say after each purchase or sale. So even you are using perpetual inventory system, still physical count is really important, because physical count can help us to detect what the detect misstatement in the records, okay? And the second thing, the thefts of inventory as well. So if there is a difference between the recorded amounts which is showing in the system and between the physical count, so the difference should be recorded under cost of goods sold as a separate line item in the current period income statement. On the other hand, if you are using periodic inventory system, under periodic inventory system, what we do, we record our cost of goods sold, okay, and inventory value at the end of specific period. So still, if companies is using periodic system, so still the inventory should be reported based on physical count. And again, if there's a difference between records and in the physical count, so this difference should be recorded in the cost of goods sold as a separate line item. Now we are going to talk about goods in transit, because this is what is gonna to affect your physical count. So goods in transit mean to say, for example, if you are living in UK, maybe maybe you are buying product from USA. So okay, maybe your suppliers will dispatch the goods from USA, and by the end of the period, these goods might be with the shipping company. I mean to say, it's in the transit. These goods are not with the seller, and these goods are not with the buyer also. So now the goods are in transit, okay, maybe with the shipping dock, okay. So now the question is that who will consider this inventory in the physical count? So here we have actually three terminologies which really need to understand. So here the first concept is called FOB, shipping point, and second concept is called FOB, destination, and the third point is called consignment. So under the FOB, shipping point, FOB stand for free on board. Shipping point means to say here the seller is responsible until the shipping points. I mean to say the risk and rewards of the inventory will be transferred to the buyer once the seller will hand over the goods to the shipping company, okay. So here you need to check here who will count under the physical count. If goods are shipped before year end, okay, so it means the risk and reward of the inventory has transferred to the buyers before the end of the year. And at the end of year, if these goods are in transit, mean to say it didn't reach to the buyer's company, so what we will do here, it's a buyer's or customer inventory, and buyer will add in his or her inventory physical count. So as I told you, if goods are shipped before year end, so buyer will add in his or her inventory. Now second terminology we have, which is called FOB, destination, free on board. Destination mean to say here the seller is responsible until the goods will reach to the destination, okay. It means the risk and rewards with the inventory will be transferred to the buyer once the goods will reach to the buyer's destination, okay. So here you should remember, here seller is responsible until destination. Like for example, if the goods are in transit, okay, maybe with the shipping dock, but there is a year end, so because these goods has not reached to the buyer's destination, so it means seller will account for this inventory. But to make it simple, these two notes you should remember: if goods have reached to the destination, before year end. And the second note is if goods have not reached to the destination before year end. If goods have reached to the destination before year end, it means it has reached to the destination. So it means the buyer will add in his or her inventory physical count. If goods have not reached to the destination before year end, it means seller will add in his or her inventory physical count. Okay, and we will practice this question as well. So when you do the question, you need to understand first, you need to identify first, are you seller in the transaction or you buyer in the transaction, and you will deal according to the rule. Then we have here the third point, which is called consignment. Actually, to understand the consignment, we need to understand who is the consigner and who is the consignee. Consignment is an arrangement in which goods are left with the third party. As you can see, a lot of retail stores, maybe if you are supplier, maybe you are producing electronic products, so maybe you can keep your products at the with the retail stores. And here what will happen, the party, I mean to say the retail store that sells the goods on consignment receives a portion of the profits, either as a flat rate or commission. They will receive just simply a commission because they are selling your product. Okay, here this is really important. Selling via a consignment arrangement can be a low commission, low time investment way of selling items or services, because consignment is a goods work around if you don't possess a physical store or online marketplace in which to sell your goods. In short, what I told you, because you can place your inventory with the third party, and the third party who is selling your product, they will receive the commission from you. So it means whatever the inventory which is held by the third party, that inventory is the consigner inventory. Consigner means to say the party who is providing the inventory, and consignee is the party who is selling the inventory. Okay, so here you should remember, if inventory is unsold by the end of the period, so what we will do, because it was the consigner's inventory, so here consigner will add back in his or her inventory, but at cost, not at a sale price. Okay, but if the inventory is sold, so it means you don't have any inventory with the third party because it is sold to the final customer. So here consigner will not do anything, they will not record in the physical count. To understand what we have learned, just let's do a question to understand what we have learned, the concept, and how we can apply into the questions. So here we go. Let's do a question. So here we have entity A's December 31st year one warehouse inventory physical count results in the amount of inventory of 50,000. Don't forget, let's assume you are the invent accountant of entity A and you have a physical count of $50,000. Okay. The following is the additional information regarding the entity A's year end inventory. So here we have a during the year entity A consigned goods with the total cost of $60,000 to entity B. So it means here entity A is the consigner, and you have to apply the rule. If the goods are unsold by the end of the period, so what we will do, entity A will add back in his or her inventory at cost. Okay. So then they're telling you the entity B, the consignee, the annual statement that was sent from entity B to entity A states that 60% of the consignment goods were sold for $42,000. So this is the sale price, but you don't need to consider sale price. You need to consider only the cost, and cost is 60,000. So if you will look at here, what we can do, so simply just we can apply certain calculation here. So as I told you, entity A, not Mr. A, it means it's a company A, who is the consigner. So they dispatch the goods with the cost of $60,000. And as per the question, 60% of the goods are sold. It means we have 40% of goods which are unsold. So what we will do, just simply we will take the cost of the product, which was 60,000 time 40%, it will give you 24,000. It means this $24,000 you will add back in your inventory physical count. So let's move to the solution. So you can check it here. So here you have a warehouse physical inventory count, which is a $50,000. So here you will add goods held by on consignment, which is 60%, 60,000 times 40%, it is 24,000. Okay, so you will add back. Now we are going to move to the second transaction. You can look at here. There's a merchandise costing of dollar 40,000 shipped FOB shipping point. So stop here and you can recall the concept I told you under FOB shipping point. If goods if the goods have hand over to the shipping company before the year end, it means buyer will consider the inventory. And here you need to know you are buyer or you are supplier here. So here merchandise costing of $40,000 shipped FOB destination point from a vendor. It means your entity A is a customer, and now just you need to confirm what is the date of shipment. Okay, so and the date of shipment is on December 29 year 1, but was received by entity A on January 4 year 2. Okay, so you received after the year end. Okay, it means by the end of the period these goods were in the transit, okay, with the shipping company, but the goods have this hand over to the shipping company before year end. And I told you the rule: if goods have hand over to the shipping company before year end under shipping point concept, so the buyers will add this inventory. So it means this $40,000 we will add because we are buyer here as entity A. So we will add this 40,000 here in the inventory physical count. Okay. So now we are going to apply the third concept. They're telling you we have a merchandise costing dollar 70,000 shipped FOB destination. Oh, this is FOB destination. If you will recall the concept I told you, if goods have reached to the destination before year end, buyers will add this inventory. If it has not reached to the destination, so seller will add. So let's check what is the date of destination. So merchandise costing $70,000 shipped FOB destination from a vendor on December 31st. It means you are a customer here. Just you need to confirm what is the date of uh, destination here. So these goods was received by entity A on January 5 year 2. It means by the end of the year, it was not reached to the destination. So it means the buyer will not add back this inventory. Okay, buyer will not add this inventory into his physical count because it hasn't reached to the destination. Okay, so this requires no adjustment here. So next point, the goods billed to customer. So here it means billed to customer. It means here entity A is the vendor. Okay, and it's a FOB destination. Again, if the goods haven't reached to the destination by the end of the period, have not reached, then the vendor, it's a supplier, will add. If it has reached, then customer will add. So here we are vendor, so you have to check it has reached or not. So here the goods billed to customer FOB destination on December 27 year 1 had a cost of $25,000. The goods were shipped by entity A on December 29 28. So shipping date is not relevant, destination date is relevant. And these goods were received by customer on January 3 year 3. It means goods have not reached. I told you if goods have not reached, supplier will add back this inventory in the physical count. And here we are supplier. So entity A will add back this inventory with the amount of 25,000. Okay. So now if you will make a total 50,000 plus 24,000 plus 40,000 plus $25,000. So it means your inventory at the end of year uh, balance should be $139,000. So I hope this is clear. If you have any question, you can ask me through the comment section. So if you really like the video, don't forget subscribe to the channel. Thank you so much. See you in the next video. Bye bye.